Schedule D is mirrored almost exactly like Form 8949, divided into two distinct sections. Part 1 is for short-term capital gains and losses, representing assets held for 1 year or less. Part 2 is for long-term capital gains and losses, for assets held for more than a year. After you have painstakingly listed every single stock trade, crypto swap, and property sale on Form 8949, it is time to bring it all together on Schedule D, titled Capital Gains and Losses. If Form 8949 is the detailed workhorse that records every individual transaction, think of Schedule D as the executive summary. This is the form where all those individual numbers are compressed into grand totals. These totals then flow directly onto the front page of your Form 1040, eventually determining exactly how much tax you owe on your investments. For the 2026 filing season, understanding how Schedule D works is the final step in ensuring you don't overpay the IRS on your hard-earned profits. The most important goal of Schedule D is to calculate the net amount for each category. For example, in Part 1, you will take all your short-term gains and subtract all your short-term losses. If you made $5,000 on one trade but lost $3,000 on another, your net short-term gain is $2,000. The same math applies to Part 2 for your long-term assets. This netting process is your best friend during tax season because your losses are used as a shield to protect your gains from being taxed. Once you have your net totals for both Part 1 and Part 2, Schedule D takes you through a specific sequence called the netting rule. This is where you combine your short-term results with your long-term results to find one final number. If you have a short-term loss and a long-term gain, the loss cancels out the gain dollar for dollar. If you have losses in both categories, they combine to create a total capital loss. If you have gains in both, they are taxed separately. Your short-term gain at your high ordinary income rate and your long-term gain at the lower preferential long-term capital gains rate. What happens if you have a terrible year in the market and your total losses are much larger than your gains? This is where the capital loss limitation comes into play. The IRS only allows you to use up to $3,000 of net capital losses, or $1,500 if married filing separately, to offset your ordinary income like your salary or wages. But there is good news. Those extra losses aren't gone forever. They become capital loss carryovers. If you lost $10,000 this year, you can use $3,000 to lower your taxes today, and the remaining $7,000 carries forward to future years. You will use the Capital Loss Carryover worksheet in the Schedule D instructions to track these amounts. In 2026, many investors are still using carryovers from the volatile markets of previous years to wipe out their current profits. So checking your previous year's return for these numbers is essential. For the 2026 filing year, the One Big Beautiful Bill Act has made reporting more transparent. The totals from your new Form 1099-DA for digital assets will flow from Form 8949 right into the lines of Schedule D. A critical detail for 2026 is ensuring that your crypto losses are netted correctly. Under current rules, you can use crypto losses to offset stock gains and vice versa. Because the IRS now receives direct reports from crypto brokers, they will be checking Schedule D line by line to ensure that your net numbers match the data they have on file. Any discrepancy here is a high-risk trigger for an audit. Schedule D also contains some specialized lines that most taxpayers rarely use but are vital if they apply to you. Part 2, line 18, is for 28% rate gains, which apply to collectibles like art, rare coins, or antiques. Even if you held these for 10 years, they are taxed at a maximum rate of 28%, not the lower long-term rates. Line 19 is for Section 1250 gains, which involves unrecaptured depreciation on real estate. If you sold a rental property in 2025, this line is where you account for the tax on the depreciation you claimed over the years. These specialized rates are why the math on Schedule D can suddenly become much more expensive than people expect. Because Schedule D is the final destination for all your investment data, the stakes are incredibly high. One math error here can ripple back through your entire return. If you are dealing with capital loss carryovers from multiple years, if you sold real estate with complex depreciation, or if you have a high volume of crypto trades involving wash sales, the complexity can be overwhelming. If the netting process feels confusing, or if you aren't sure how to apply your previous year's losses to your current gains, we strongly urge you to contact a tax professional. A CPA or enrolled agent can ensure that your Schedule D correctly utilizes every dollar of loss to lower your tax bill while avoiding the traps of specialized tax rates. Navigating the 2026 investment landscape is tricky, and a pro can help you ensure your final summary is accurate and optimized. When in doubt, seek professional advice to protect your portfolio and your peace of mind.